We were just talking there in the ad break about Meta being the company that's really standing out to you at this point. Why is that exactly?
Sure. Well, I mean, look, earnings season is relatively young at this point. I could argue it's really been less than a week where we've seen major companies reporting their December quarter results and providing related guidance. I think prior to the results we're talking about, Microsoft was probably held out as the company that delivered most significantly across a number of different dimensions, whether you're looking at revenues, you're looking at revenues across multiple kind of segments within the business, margins, et cetera. But if you look at Meta, as you alluded to, Meta's revenues were up 25%, driven by strength in advertising. It seems like the company is really not just back on track, but really executing strongly. And I think it's really a testament to two things. One is the company's ability to kind of focus and pivot on what's most important. And then, of course, wrapping up their so-called year of efficiency in 2023, that really helped them from a margin perspective.
Yeah, it's interesting because if you were to go back to October last year, we heard from Meta executives and they were saying that global economic uncertainties could be something that would weigh on revenue. But actually, Meta did a lot better than, say, Alphabet, which also gets a lot of revenue from digital advertising and is also investing heavily in AI.
Yeah, I mean, it's hard really to understand at this point the distinctions in terms of why, say, Meta performed so well, but yet Alphabet was really more mixed. I think it's fair to say if you looked, for example, at Alphabet's search and advertising revenue performance, I think it was good, but it was not as good as some people might have hoped and some actually expected. In the case of Meta, it seems like the results were not just good, they were very good and in excess of, I think, just about everyone's expectations that, are looking at and following this company. I think there are a couple of conclusions that one could draw. I think one obvious one is that Meta has been more focused on monetizing some of its more emerging assets, most notably Reels, which is obviously a short-form video product. They seem to be doing really well there. We've heard from experts time and time again that not only were they performing well, but that the future looked bright when it came to Reels, even though, of course, there has been an uphill battle as the product competes with TikTok. It seems like that particular offering is performing really well. On the other hand, I think there are some questions around YouTube and YouTube Shorts, which is obviously Alphabet's kind of entrant into that short form video race. And I think that's one way to distinguish among the two companies and how they performed over the quarter.
And Meta's obviously taking, I guess, more of a longer-term view as to how it strategizes on AI, right? Do you think, the availability of these large language models for free is going to, at some point, irk investors who want more of a monetization strategy when it comes to artificial intelligence?
Right. So if you're talking about Meta more specifically, I think it's fair to say that they're taking a more pragmatic approach. A couple of indications of that. I think first things first, right? If you think back to 2+ years ago where the company renamed itself Meta Platforms and reoriented around the metaverse, they created two segments, Family of Apps and Reality Labs. It seems pretty obvious that they've been pulling back investment from that Reality Labs segment. And nothing could be a stronger indication of that, at least in my opinion, than the fact that Mark Zuckerberg, I guess it was now, a week, 2 weeks ago, publicly announced essentially that the AI group that consists of roughly 1,000 people was going to be realigned under the Family of Apps, which tells me that really what AI is going to be at Meta is kind of supporting and helping those existing products and offerings with enhanced kind of functionality when it comes to AI. It seems to me like the goal here is to really kind of prop up and squeeze as much opportunity out of what Meta is already doing when it comes to existing businesses and solutions. And I think that's pretty noteworthy as people wonder about whether this is capital well allocated, so to speak.
Scott, from Meta to Apple, which obviously was a lot less in terms of the good news, is this just a China demand story, or is there kind of more existential issues now with China's product, with Apple's product demand and the product cycle more broadly?
Sure. I mean, I think it's fair to say that for years and years, people could point to the law of large numbers being kind of an impediment to Apple delivering outsized growth. But the good news is obviously that the company, in fact, did deliver revenue growth for, I think, the first time in over a year in the December quarter. However, I think it's fair to say that there is a fair amount of, let's call it, conservatism and skepticism when it comes to not just the results, but the go forward kind of opportunities for the company. Even a standout segment like services only generated 11% growth. I think that was less than expectations. And I think Apple overall has sounded a tone suggesting that growth is going to be more elusive over the near term. And so this is a company that, not a lot long ago was really generating substantial growth. And now I think there are some questions about where, in fact, that growth is going to come from when you see a mobile phone market that many would suggest is saturated with already very premium pricing.